I'm back with another case study, and this is for those of you that have the majority of your assets in pre-tax accounts, such as 401ks or IRAs. I'm going to show you how that affects your retirement because the truth is most of you don't have everything in Roth or brokerage accounts. The majority's in a pre-tax account, like a 401k or an IRA, and you want to make sure you don't pay more taxes than you need to. I'm going to show you that in this quick video to understand how you can optimize your retirement. My name is Taublieb. I'm a certified financial planner. I'm the host of the Early Retirement Podcast, and I'm the vice president at Roth. If you're looking for more information on tax strategy, withdrawal rates, healthcare, estate planning, investing, all of your financial life, you're in the right spot, and I invite you to subscribe. This was prompted by a listener question who said, hey, I've got almost everything in pre-tax assets. How should I approach tax planning in retirement? So I'm going to show you right now. So here's a case. This is John and Haley Smith, real people, but just fake names here. And how old are they? Well, they're 60 and 52. So there's an 8-year age gap between them, which comes into play in a little bit, and they don't have any children. In terms of assets they're working with, they have $85,000. That's just sitting in their bank account. That's what they're comfortable with. They have $2.2 million, of which the majority of it, 2.2, is in a 401k or an IRA. And then they have 65,000 of a few stocks that they picked in a brokerage account, which I nickname a superhero. No mortgage, and they want to retire with confidence. They just want to make sure they're doing it at the right time. So we had a long conversation about their goals and what they're on track for, and then we wanted to take it up a notch. And so I'm going to show you how real tax planning works right now. So look at this. Right off the bat, you're like, oh my God, is this like English? What am I looking at? It becomes quickly overwhelming. I'm not going to let it. All that you need to know here is these different lines that look a little confusing. These are tax brackets. So if we zoom in here, this blue line at the bottom, that nice little turquoise cayenne, if you will, for those that use a printer, maybe it's cyan. Anyway, let's keep it cayenne because it sounds cool. 10% bracket. This next green line, 12% bracket. This next tan line, 22% bracket. And the orange is the 24% bracket. Now you can see they all have a slash there because the brackets are changing. So you're like, okay, why are you telling me this? Well, here's a couple, and all the blue, by the way, important for me to mention, all the blue that you see filled up, that kind of deep ocean blue, that's income. So it's kind of low here because here they're only, you can see, just almost filling up the 12% bracket. Low income for today because they're nearly done working, almost retiring, they've scaled back. So here they are with their current income and their current brackets. Now what you can see is here they are and things look pretty smooth. 60 and 52, okay, maybe they retire at 65, maybe they retire earlier, but you're like, well, what's the big deal here? Well, the big deal here happens right here. And many of you are like, oh, I know what's happening right here. This is now all of a sudden RMDs coming in saying, hey, you're going to be forced to take out more than you even need to. And they're like, I don't need 500,000 of income. And the government's like, well, we don't care. That 2.2 million keeps growing. You got a tax deduction for it up front. Now we're going to come and get our piece. And so what's happening is now it's going to keep growing. And wait a second, these are the years maybe they're not traveling as much. Wait a second, these are the years they have Social Security. And so now all of a sudden they've got Social Security. And I'm going to show you an example right now because this we're going to come back to, but I'm going to show you a real tax sample. So look at this. Here we are inside a real tax sample. Here's a couple and their income. And you're like, wait a second, $224,000. I thought you said they were retired. This couple right here, they are approaching retirement. The couple I'm talking about, here's a real couple that is retired. And so they're retired and you're like, well, why do they have $224,000 of income? I go, this is where the couple I just showed you is about to be. This is what's going to happen to them if they don't do good planning. So right now you're like, is this me? This isn't you. This is where you're going to be if you're not strategic. So here they are. They're almost filling up the 22% bracket. So by the way, guys, this is like my little checklist here that I'm going through with clients. And so here you can see they're in 193,000 of taxable income, almost filling up this 22% bracket. If this keeps increasing, they're going to be paying more and more taxes. You're like, what's the big deal? I go, well, the big deal here is they're going to be paying a lot of taxes. Their income keeps growing. This 24%, well, guys, when brackets change, now it's 25%, and it keeps growing and growing. That's not why I'm showing this to you. I'm showing this to you because of this graph right here, this little chart right in the corner. You might know about this, you might not. This is a new bracket system, not new to the world, but maybe new to you, that's going to occur. So once Medicare gets turned on, there are what's called IRMA surcharges, and IRMA is not your friend. You have to pay extra amounts based on your income. You're like, oh, that's cool. What do I get? You get nothing. You just have to pay more. So each spouse is now spending $70 on Part B premiums. You're like, oh, who cares? $840 a year? I go, you care. It's $840 today for both you and your spouse, not including Part D, and that continues to increase every single year based on your income. So if your income's growing, well, now maybe we're paying $4,000, $5,000, $6,000, $7,000 between both of them every single year unnecessarily in Medicare premiums. You're like, well, I don't want that. That's what's going to happen once Medicare gets turned on here. So if we just kept letting our accounts grow and grow and grow, we're going to get hit with Medicare surcharges. I even get excited about it. You're going to have to pay RMDs. You're going to have to pay a lot more in tax than you need to. So what I'm showing here, guys, is an example of why we do Roth conversions. So once again, keep it simple here. Here they are today. They're working, simple enough. Income drops. Well, now income drops because they're retiring. In this example, 65, but I show you different variations just for simplicity. Then their income jumps at 75. Now, they don't need as much money. So the question here is, what if we do a conversion? And what if we fill up the 10% bracket? Well, filling up the 10% bracket, it helps. It adds a few $100,000 more dollars. You can barely see it. It's actually right here. It's this little green. It's kind of hard to see in here, but you can see it. It's this little divot here right at 65. That's where they're doing a little bit of a conversion. But what if we essentially did a bigger conversion? Would that add more money? Oh yeah. So what this is saying is, if you're doing really intentional conversions, moving money from your IRA to your Roth IRA, I call it eating a little bit of cauliflower to avoid eating a lot in the future, you can avoid a lot in taxes. And so all you're doing is moving money to let it grow tax-free. You're saying, yep, I'm happy to pay a little bit in taxes to avoid paying a lot in the future. And so if we keep doing this, it gets cool. It's like, oh my God, we're really, potentially saving millions of dollars in tax-free. This is insane. So someone came to me once and they're like, whoa, this is cool. I saw how it worked, but I never understood it. This is, oh my gosh. And they said, can we just do it all? I go, you could absolutely do it all. And it would be better that you did nothing at all. I mean, if you went and just did all these conversions, someone once came to me and they're like, Ari, I kind of already did these conversions, gave me a little attitude. I'm like, I wish you did nothing. They're like, why? I go, you did so much in conversions that it's actually shooting yourself in the foot. It would have been better to do nothing. So what you want to do is don't over convert. Don't convert so much that it'll actually decrease the benefit. If you over convert, it's not the end of the world, but there's a sweet spot and there's a way to do it. And it's based on brackets that change and timing. But the key here is this can save a lot in taxes. The other way I like to show this to my clients, just to really make it aesthetically pleasing, because there's a lot to this and it becomes overwhelming, is on a cash flow page. So a cash flow page can be very, very powerful. So I'm going to show you an example. So here they are now, nice couple, and they're working and they're bringing in income, and that's great. But what's going to happen here? Let's fast forward to the future. Just humor me, guys. Look at this. Let's assume they're 2039. Well, there's an age gap, which I mentioned early on, which means both RMDs are not occurring. It's one and then the other. It starts at 75. So here they are, and maybe between Social Security and other income sources, they're bringing in $57,000 adjusted for inflation. But also $230,000, that's coming in the door, meaning $230,000, those are required distributions. And they're like, whoa, 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 I don't need 230. I don't need that. And I'm like, guys, I know you don't need that, but you have $57,000 of Social Security, $230,000 of RMDs, which means $288's coming in. You only want to spend $112,000. This 56, guys, this is a tax payment. So this is including taxes. I like to include that when I do projections. This means $168,000. That's actually what they need. They need $112,000. They need to pay their taxes. So they need $168,000. Well, they need $168,000, but $288's coming in. That's $120,000 getting taxed at their highest tax bracket. And you're like, whoa, now I kind of see it. This continues to increase as retirement goes on. And now they might be paying literally, now if you're here in California like me, there's no reason they're not paying 40, 50% taxes on this amount of money. And you're like, well, I don't want that to be the case. This is the benefit of doing good planning. Now, Roth conversions, just one sample, but there's a lot of different planning points. If you have all pre-tax assets, there are instances where I tell a client, I need you to retire earlier because I need to be able to implement these conversions for you so that you don't get killed in retirement. They're like, you want me to stop working just for tax purposes? I go, sometimes I don't want you to do that at all. My best example, someone came to me once, I laughed. They said, hey, Ari, I'm thinking about declining a bonus. I'm like, why? They're like, well, you don't have to pay taxes. I go, yeah, but it's still a net positive to you. You're going to get your bonus and pay taxes and end up with more money than if you didn't get the bonus. They're like, no, I know, but I don't want to increase my taxes. I'm like, okay, don't do that. I want to make sure you're thinking through it properly, but there's a lot of nuance here. So Roth conversion is really powerful. This couple, they're in a good spot. So if you're like, oh my God, are they going to be able to retire? They're going to be retired. You can see here, they're on track right now based on their assets. Plenty of money. That's not their concern. Their concern is dying with too much money and paying too much in taxes. So hopefully this video was helpful for you guys. This, of course, is software access to you through the Early Retirement Academy. And if you are looking for a holistic planning service to make sure you're optimizing what you've worked so hard for, it's what we love to do. And I encourage you to reach out in the description below, and I'll see you guys in the next video.